Danielle, thanks for joining me today. How are you?
I'm well, thank you, Dale, and thanks for having me on the show.
No dramas. It's a pleasure. I've been looking forward to this chat for a while now. So, I suppose to start with, Danielle, really fascinating sort of insights into your, I suppose, journey so far, and it's been a career that's full of I suppose a lot of different aspects of investing. So I think the first thing I'd love to go through with you is really your journey and how you got into investing and then sort of how it's evolved over the years.
Yeah, sure. So I started out in institutional stockbroking as an equities analyst, and it was more by luck and being fortunate than by design, because in 1986, I think it was, really, it was really the start of a very, very big bull market, and I just got lucky. Someone said I'd be quite good as a salesperson, and really the investing journey, it did start then, but it really started more in London because my cash flows started to pick up more in London. And although I did invest in shares, I probably saved more through property at the time. And really, my whole, even though I was stockbroking and advising some of the largest clients, pension funds, basically like superannuation funds in the UK market in the 90s on emerging markets, my real investing journey personally only started when I moved back to Sydney in around sort of 2004. And for some bizarre reason, I was lacking confidence that I could do it myself because I'd lived overseas for 13 years. So I'd be better off giving it to somebody else. But it didn't take too long for me to decide that actually I could lose my own money quite efficiently without paying huge fees. So around the time of the start of the GFC, I actually took control of my funds. So I've been doing it actively myself for the last 13 years. And it's a very, very different experience from advising large institutions about how to invest versus how you invest for yourself. And also, there's a great difference between whether you are having cash flow coming through the door, as in you have earnings capacity, so the investing is part of your savings program, or as it has been for me, where I have actually been living off my savings and trying to grow them over time. And that changes the risk profile completely. So there's been lots of dynamics kind of going on over the last 13 years and that continue to go on.
Yeah, fantastic. And so when you decided to make that change between obviously someone managing your money and you taking it over, you said that you could do a better job of that yourself. What were some of the things you were seeing between sort of that managed fund and the sort of decisions they were making versus sort of how you saw you could do it differently?
Mainly it was in the risk profiling. And when you give
Hmm.
your money to a fund manager, you are by definition saying to them that you are happy to remain fully invested in the share market. And where I had a strong disagreement was at the start of the GFC. And did I know the markets were going to fall by 50%? Absolutely not. But I was really, really nervous about the capital destruction that could occur at that period in time. And I think the great quote was when I said to the guy who's managing my money, I want you to sell everything. And he said, no, no, it'll be fine. It'll recover in 10 years. And for me, I go, well, I really don't have that 10 years to have that much capital destruction. And the other thing is at the time it was but probably what we'd call blue chips in Australia. So you can name them all. It was the big banks, it was BHP, it was Brambles, CSL, which I probably should never have sold at the time. It was also stocks such as the fund manager, and I've just forgotten the name of them. And basically, a lot of those companies, like National Australia Bank, has never recovered. A lot of the banks have never, excluding
Mm.
Commonwealth Bank, to the share prices that they were back then. And really, this comes down to people having to appreciate where their risk tolerance is and what they're trying to achieve. because a lot of older investors are happy to sit on their bank shareholdings for years and years and years. They've got a very low entry price and they just cream off the dividends and they take their franking credits and it's sitting in a self-managed super fund. So happy days, they don't really care that the capital value has gone down because the yield by and large on the stock has continued to go up until recently. I was a different age group. I had a different outlook. It was not the way I wanted to invest. So when you invest with a fund manager, they always come from their perspective of what their mandate is for investing. And people need to understand that you want to align that very closely with yours. Otherwise, you're likely, like me, to get frustrated when you get years where the fund managers massively underperform and you're kind of saying, but I'm still paying these fees. Why am I still invested there? And that's kind of the view that I took. I prefer to have control and I use my cash positions rather as my hedge. So if I get nervous about the markets, I raise the cash positions in my portfolio. So I have some cash to invest when they sell off or when there's a good stock opportunity that comes around.
Yeah, very interesting. And I suppose a lot can be said when you talk about sort of how the fund managers manage and ensuring sort of that outperformance. I know a lot of our listeners are probably investing themselves, but it's also a way to think about your superannuation too, right? You see a lot of these retail funds and how they perform against the market and people that just don't switch. And it's always worth sort of keeping an eye on how they're performing against those things. In that same context where you're talking about fund managers and sort of trying to achieve outperformance through them and those kind of things, how do you see the future of fund managers for people's money, given that you've got all these passive sort of vehicles like ETFs these days that are sort of giving you a benchmark? How do you sort of view the industry sort of for fund managers moving forward, and do you see value in them for ordinary people?
Yeah, again, it really comes down to how the fund manager is managing, and what I mean by that is the style. And it's become very pronounced, this huge differentiation between what's called value investing. So that's buying lower PE valued stocks or priced stocks, I should say, price rather than value, because we could argue whether they are good value, and they tend to be more cyclical, versus that other big pool, which is kind of growth investing. And then you have some investors that take very high risk bets, and they invest globally by way of definition, as opposed to just in Australia. I think the active fund management industry will continue to exist, but there's no doubt there is pressure on their fees, and the pressure on the fees will grow when there's pressure on their performance not working out. I think potentially over the next 12 months, for example, we could have a situation, and I've seen it recently, where an index goes sideways, but yet there's lots of money-making opportunities below the index. And that means that some of the index funds may not do as well as the active managers. And therefore, it really is a case of if you are allocating your money out, I always say with my portfolio, I have an approach where I use an ETF, for example. I call it like the backbone of the portfolio, particularly in the country, like when I allocate to the US. So I own like the S&P on a market cap weighted basis. And then I stock pick around that. And the reason I do that is that it's just nice to have a chunk of the portfolio that's just going to chug along over time, because when you have a drawdown event, you can find that the S&P might fall 20, 25%, but some stocks could fall as much as 35, 40%. And so for me, it's kind of like a hedge. So really, this all goes down to when you buy an ETF or you invest with an active fund manager, it's really important to understand the mandate around the fund. What are they
Mm-hmm.
trying to achieve? What's their stock picking style? And ditto with an ETF, when you go to buy it, it's really important to understand if you buy like the S&P 500 or the ASX 200, that you're going to get a large swag of certain stocks. And then if you start to stock pick on top of that, are you doubling up on those stocks? So, if you decide, yes, I want to buy the ASX 200 or whatever, but then you say, oh, but I'll also buy a lot of banks. Well, you're effectively doubling up there because the weight of the financials is so heavy in our market. Alternatively, in the US, if you buy the S&P 500, you're buying a lot of Apple, Microsoft, Amazon, Alphabet, etc. And it's just, again, it's always a case of just, I think, understanding what stocks you're getting exposure to, because this is always about really, I suppose, I think understanding if there's a drawdown in the markets, why the stocks are falling, so that one doesn't actually panic and sell when one shouldn't.
Yeah, and on that note as well, I know I'm going a little bit off topic here, but you talk about when things are on their way down and one shouldn't necessarily sell just because the price is going on the way down. Do you want to take us through how you think about that exact situation? So if you believe in a company, but its stock price is going the wrong way, how do you kind of, maintain your conviction in that stock, or how do you know when it's the right time to move on?
Yeah, that's a really good question. To a large degree, it will have some dependence on what the macroeconomic drivers are. And you're seeing that a lot in the share market at the moment, around whether we're in a high inflationary era where central banks are going to have to raise quite aggressively. Obviously, the central banks are denying that. They're saying, no, we're not going to move straight away. But investors need to understand you can have a great company, particularly in the technology sector, that's growing really highly. But if interest rates are going to go up more quickly, the valuation is going to be compressed. So with the best will in the world, the price is going to come down. And that's called, basically the devaluation doesn't have to do with the quality of the company or of the earnings growth, or even of the if there's any cyclical nature, because a lot of them are not necessarily cyclical, they're secular, but the valuation is going to come down. And again, you have to try and understand. So to give an example, in the US lately, there was a downgrade in a company called CrowdStrike, which is a cybersecurity stock. I pretty much owned it since the IPO. I've made lots of good money on it. And Morgan Stanley came out with a downgrade on the recommendation. And a lot of it was based around the fact that the valuation was too high for the earnings that were coming through from the company, and there's going to be increased competition. Rightly or wrongly, I've made good money on it. I actually did sell it. And the reason why I've sold it is I'm trying to move my US portfolio into stocks that are still exposed to the secular themes that I like, so like cybersecurity and decarbonisation and fintechs and all of those. But where I'm trying to position it is, rather than being on the outlying high growth stocks that are not making any earnings, that have done incredibly well over the last few years, I'm moving them down the risk curve to companies that are more the traditional names. So in this case, a Palo Alto cybersecurity stock, which is not as expensive, which actually is on a lower valuation multiple. And the reason is, if there is that potential, connection in the market, I'm positioned still in the theme that I want to be, but in a more defensive stock, if that makes sense.
Yep, that made plenty of sense. That's a really good example, and some good examples of stocks to really put to mind for our listeners. And I suppose, again, sort of a bit off topic, but you spoke then about sort of inflation and where that's heading. Do you have any particular views on whether inflation's here, or do you think it's sort of transitory, like they're saying, and that we're going to sort of see this pass?
Yeah, the big problem I see is the pandemic, and you're seeing a huge increase in Europe, in Northern Europe at the moment. And I noticed Vietnam now is having another lockdown there, and it's obviously got lots of manufacturing facilities for the likes of Nike. I think the biggest problem at the moment is that we haven't solved the supply chain problems, and they're not going to be solved until we solve the pandemic problems. And of course, that's really difficult because, like in Australia, you know, we've all been quite compliant with our vaccinations, but the US is only sitting at 58%. And we're still trying to vaccinate the rest of the world. So I think that people have completely underestimated this concept, like, you know, COVID's here, but we all get vaccinated and life's fine and we all go back to normal. I think everybody should start to face the facts that the normal that we knew pre this pandemic are not coming back really in the foreseeable future. Even if you want to travel overseas, as far as I understand it, if you test positive before you get on the plane, it's like, sorry, turn around, you now have to go into quarantine for 2 weeks. And I think there are a lot of us, like I was speaking to my dear physio chiropractor, and his wife's Spanish, and he goes, I'm not going to go to Spain with her and the family because I can't afford to get stuck over there for another 2 weeks, even if we can stay in the family house in Madrid. So the ease with which we did things and the way we behaved has fundamentally shifted. And as Sydney comes out of this lockdown, it's quite noticeable that the foot traffic apparently in shopping malls is still running 50% below where it was pre-pandemic. And I think that when we talk about inflation, the most important thing for investors to understand is that you have supply side inflation, you have demand side. And at the moment, it's supply side constrained that's causing a lot of it. When it becomes demand that it keeps picking up, and also that inflationary expectations become embedded, like people and you and I, and we change our spending patterns. So we pull forward our purchases and we ask for huge wage rises, which is actually what central banks want, but they don't want it to get out of control. And I don't think we're at that point yet. And I don't think Australia is like the US. We've already seen housing started to turn down here in Sydney. And I think that the consumer is a bit bashed around after the second big lot of lockdowns here in New South Wales and in Victoria. I don't think it's as strong as what it was a year ago. So on balance, I think the inflation story has a lot longer to play out, which of course is going to cause more volatility for investors.
Yeah, fascinating. Interesting to hear too, the shopping centre stuff in Sydney. I was talking to someone at Westfield the other day, and so their centre traffic over in Perth and South Australia, where they've not really been affected by COVID at all, is largely at 100% of what it was before COVID. But yet it's really funny to see where the patterns are in consumer behaviour as well, and what's driving people, where the areas that are largely unaffected by the pandemic have kind of just continued on as if nothing happened.
Yeah, because they've had their economies basically shielded. And I mean, you kind of wonder, one has to think, wow, what's going to happen when they actually get some COVID cases, when people are allowed to travel to Perth and Adelaide again?
Yeah.
Or Brisbane, should I say?
Yeah, I think we're opening the borders up here pretty soon. I think I read.
Quickly,
Yeah.
down the hatches.
People will add in soon. Great. All right. Well, I suppose it's we've done a little bit about on your journey. So, do you want to take me through now? You've sort of had this amazing career that's then spanned into all these learnings in your own personal life. How did the book come about? What made you then say, all right, it's time for me to become an author and start to share some of this knowledge?
Yeah, it's kind of, yeah, it's a bit odd. I wrote, so basically I gave up my career for looking after my son, or gave it up. I just chose not to continue with it. And when he was doing his HSC, I thought, oh, I really need to do something now. Like, he's going to leave school and yeah, I'm not going to be as busy getting up at 4:30 in the morning for rowing now. I need to get a life. And I sat down and wrote a manuscript about total wealth management, and I sent it off to a whole lot of publishers. And the upshot of all of that was I eventually got a publisher, and she said, yeah, no, that's not going to work for us. And I said, well, what would? And she said, well, we haven't had a book on share investing in Australia for a while. How about that? And so basically, having just written a large manuscript, the Shareplicity was, I think we met in early November in 2019, and the book was delayed due to the pandemic, but it came out in May 2020. So we had an amazing turnaround, I think, of 4 months of me writing it and it actually, going off to be published. And that's how Shareplicity, a simple approach to share investing, was created. And it was a really good exercise for me because I had to explain complex things simply. And that's what I always say. Explaining complex things simply doesn't mean you're being simplistic. You're just trying to help people understand the essence of stuff that is financial jargon, is complex.
Yeah. What was the most complex you think that you had to break down?
Oh, it's everything from people understanding how, a share price is not an indication of how good a share is or whether it's good value.
Mm-hmm.
The likes of what is secular. When I first wrote secular, my publisher goes, what on earth are you talking about? How can stocks be secular? As in a religious statement. And I'm like, no, these are long-term growth markets. Trying to explain the significance of earnings and dividend growth and why high yield is not always what you want. And the most difficult and challenging for investors is understanding that expensive stocks on traditional methods like PEs
Mm-hmm.
can represent better value than buying a cheaper PE multiple stock. That's one of the hardest things because people have been traditionally taught you have to buy, stocks that are on low multiples because they offer better value. And I learned when covering emerging markets, so I did Indonesia, Philippines, and Thailand in the 90s, and they were big bull markets. But when foreigners came in and the locals just knew these big families, because everything's owned by big families over there,
Mm-hmm.
they could see this wall of money coming in. And not all of them had a whole lot of morals and scruples, right? So when they see all this foreign money coming in, they're like, yee-haw, we're off to the races, which meant that the investors had to be more subjective about picking really good quality stocks, which would probably fit with better environmental, social governance screening factors now that narrative is developed. Back in the 90s, because you could sleep well at night that you weren't going to lose all your clients' money because the company just suddenly decided to do something dodgy, which does happen in emerging markets. They don't have the same governance, and there's more sovereign risk.
Yep, that's a polite way to put it. And you launched the book in May. So I suppose a sharing boosting book right at the start of a pandemic. How did you find that readers? Obviously, it's been a few awards on the books. Obviously, people picked it up in droves. We saw a lot of investors coming into the market around, what was it, April, as the market started to rebound. So how did you find launching sort of right in the middle of a pandemic?
Well, it was going into almost being printed, and we had to quickly stall that, and I had to write something about the pandemic because it literally was a case of we had peak market in February the 14th from memory, to be exact.
Very
and
specific.
then everything started to go whoomph and disappear off a cliff. A lot of people had really underestimated that this one was not just going to be contained in China, which obviously they'd done with SARS, etc. So I quickly rewrote stuff. By and large, all the stocks have pretty much held up in terms of the way I described in the book. I think the case studies in the first book are really, really helpful for investors to understand how to look at companies. I talk about why I sold Boeing at $440. It's still at $220, 18 months, 2 years on. I talk about why I sold A2 Milk, which actually, even though it went a lot higher, it's now half the price of what I sold it at. And the stories that came out of that book help investors understand that you can sometimes be right too early. So does that make you wrong? Or it's like investing's not a game of perfect. I always say there's a book, if anyone golfs, golf is not a game of perfect. And investing is very much the same. You're never going to get it right all of the time. And if you try and do that, you're either going to overtrade the portfolio or you're just going to have an internal meltdown, because it's just physically not possible to be right all of the time. So these are some of the things that I tried to flesh out in the book, and tried to explain the differences between all the different narratives that exist out there. I mean, somebody could say, hey, Dale, a great example, Whitehaven is a great stock. It's trading at 2 times earnings, and coal prices are at record highs, and fill your boots, and it's on a 12% yield. Well, that might be the case. It's already up 144% this year. If you didn't have ESG filters and you're happy to buy a company like that, you may find at some point, like everybody that piled into Fortescue and BHP and Rio Tinto, where they're on huge yields, oh, whoops, the share price has just come off 35% because the iron ore price has fallen. Mm-hmm. So that's the problem with cyclical commodity stocks. You can be the best lowest cost producer out there, but if your external input price decides to collapse, and there's nothing more alluring than buying a stock that's just gone up so much. It's infinitely more attractive after it's doubled than when it's halved. And that's the problem. And you said you'd been doing some stuff about the psychology of investing. And that's one of the hardest things for people. It's like everyone wants to buy Tesla at $1,200, and then Elon decides that he's going to dump his stock. And everybody's like, well, I don't want to touch it now. Arguably, if it gets down to 800, 850, it's a screaming buy. And that's the problem. So trying to explain the context around stocks, I think, is one of the hardest things for investors to understand.
Yeah, absolutely. And I think with cyclical stocks too, it's always about, whenever you've got price takers rather than price makers, you've just always got to be paying attention to that cycle and where we're at with the spot prices on those commodities, because that will ultimately always just end up back. BHP was one of the ones that I first bought way back right at the start of the GFC, and I watched that do the full circle. So
did you sell it though?
In the end, I sold it when I shouldn't have, and then watched it climb higher than I expected it to. So I think I sold it back at about $42 or something like that. But so
but you're probably still looking sweet. So there you go.
It was just an interesting learning. It was a learning one for me, that one, where I was watching, something that I thought was, safe as houses, just sort of cycle straight out of favor, and down it went, and I just sort of watched it and away it went. But yeah, it's there's always some learnings from the ones that you lose a bit of money on, isn't there?
Oh, you have to have the losers, otherwise you don't learn. And life has this way, as does investing. It'll keep throwing the same things at the investor until you get it right, until you stop making the same old mistakes.
Yeah.
And this market at the moment, and we're kind of midway through November, is a classic market where you're getting this constant switching. One day everybody's buying technology and healthcare. Next day, no, we're back buying resources in the banks, and it's flipping all over the place. And it's those markets that are quite hard for investors, because you kind of have to stick to your guns, which is really hard, because you go, oh, but I want to own the stock that's going up today. If you look at your portfolio that often, that is, yeah.
Yeah. And how often do you look at your portfolio?
Oh, far too often is
Yeah.
the answer to that one. Far too often.
Like the
But
rest of us.
the other thing is that since we've touched on cyclical, so let's, if you want to, do you want to touch on some of the secular themes, all the big
Yeah,
ones, and
absolutely.
where all the
Yeah,
meme stocks come in?
absolutely.
Because
Yeah.
that, I think that's really important at the moment. In the US, it's really pronounced over there. So the whole decarbonisation theme has just had its second massive run because of COP26. And it also had a run around the same time as Biden won the election last year and in the run up into February. And what I always say to investors is it is one of the biggest themes out there. And if you believe Mark Carney, former head of the Bank of England, and everybody else, it's US $130 trillion that is going to need to be invested, over the next 20 or 30 years. Like all big themes, it probably is not going to play out the way we expect. And picking the winners is incredibly, incredibly challenging. And at the moment, you're seeing that massive bubble in EVs, and whether it's the recently listed Rivian, that has the most crazy valuation. It's like the value is, probably up to 3 times Tesla at the moment. If you were looking at multiples, Rivian's, I think they've made 12 vehicles. I mean, it's just ridiculous.
I think it was up another 15% overnight too.
I know.
Yeah.
I know. So that has captured like the meme mania, the FOMO. We've seen it in the US with a lot of stocks like AMC. I bought Moderna because I thought, oh, this is looking interesting. And before I knew it, it doubled or something. And I'm like, whoa, that happened a little bit quickly. So I sold it. And you will see it here in Australia as well with certain stocks. So for a while there, everybody was into some of the smaller cap ones like Redbubble and Kogan. And, it all goes terribly well until suddenly it doesn't and they turn into absolute dogs. So I say to people, just be careful if the theme that you've invested in suddenly it becomes flavor of the month, the week, or the week, the month, or the 6 months. And the moment it's the metaverse, like all the metaverse stocks in the US are just going absolutely berserk. Roblox, Unity. I bought some Unity software because I thought, oh, really interesting. Listening to the CEO, I thought, oh, well, I'll just have a little bit of that. That looks a bit fun. Oh, I mean, couldn't have been, double the position. It was gone. It was off to the races because it just coincided with Facebook becoming metaverse. So that's currently, along with decarbonisation, one of the big ones. So again, it doesn't matter how good the company is and whether they get the earnings through, when there's that momentum and it's meme and all the retail punters are piling in, at some point, from a risk perspective, it's not a bad idea sometimes to trim the position.
Yeah. And so when you think about that and you're building out your thesis on some of these stocks and thinking about when your exit strategies are going to be, when you start to see this sort of momentum, is it sell completely out when you think it's sort of become crazy, or is it just kind of trim the position and hold on to sort of an original piece because you still think that company has merit?
Yeah, it really depends on the company. I use Tesla as a great example. I didn't sell any at 1,200. I'm looking to add to it as it falls because I still think that is probably going to be the major winner out of all of this. But in the same breath, I have forsaken like Ford doubling over the last 12 months, and there are a number of, let's say, charging companies for charging stations for electric vehicles, which have gone through the roof as well because of the infrastructure plan. I think I treat my portfolio like I have my really big core holdings that I love. So the Microsofts, I've got Morgan Stanley, I've got, I do have a position in Apple, I've got a big position in Alphabet, and I even bought back into Netflix finally at the right time. But they're the ones that I kind of keep as the core, and then around the edges sometimes I'm probably a little bit tradey and I see an opportunity and I dip in there. But in Australia, the portfolio tends to be a little bit more stable. I tend to stick to what I call the quality stocks, a lot of them that I wrote about in the book. But then I haven't been afraid to sell out of things such as Appen and Nearmap and Altium, even though that's been quite strong this year, because I felt that their business models were being challenged. So that's the question that everybody needs to ask themselves. Is the company, does it have the strength to survive increased competitive pressures, changes in the marketplace? As you said earlier, are they price makers? Are they price takers? All of those factors, because it's often a lot easier with companies that have been around longer to be able to pick that they're going to keep on winning than some of the new companies that have come to market, because they don't have a track record.
Yeah, that makes sense. And I suppose you mentioned a bunch of US listed stocks, and obviously trading in the US has become so much easier over the last 5 years and that kind of thing. And I suppose that's the basis for your second book, isn't it? So is what sort of brought on the thought process behind writing the second book? Was it just those kind of factors?
Yeah, totally. I thought like everybody should know about all the opportunities over there. Because it is, you do need time to look at it and do it, but it's a bit like a kid in the candy shop. There's so much to so much to look at. And it's also from a risk perspective, here you have to buy like a company that's maybe worth 200 or 300 million, but over there their small caps are like 20 billion or 50 billion. And it's just it's a whole different scale and dynamic. And I really do believe that we're in a great period of change, and strong companies are going to get stronger. And I just felt that depending on one's risk profile, I just didn't want to have all my money invested here in Australia. So for me, the obvious choice is the US, the largest markets in the world. Emerging markets, just for some of your listeners, they do well when the US dollar is weakening, not strengthening, because they have a lot of US dollar denominated debt. And typically markets such as Japan and European markets and the UK, they're typically what you would call more value markets. They're more mature markets. They're more stodgy. The earnings don't grow as much. They've got more, UK's got a lot of, financials, oil stocks. Europe, clearly there's some very large companies, and Japan's been trying to recover since the early 90s. So I don't tend to diversify that much. Someone said, well, do you stock pick globally? I mean, I can't. Fund managers struggle to do that. You have to have a really clear screening process to actually do that, and that's not my mandate. I'm Danny sitting at home with my CNBC and my little subscriptions. I don't, get all that research. So I say to investors, if you're looking to invest overseas, and you can do it through ETFs in Australia, you typically, and institutional investors would do this as well, you either look at it from a country down basis, or you can look at it from a stock picking, which is incredibly hard globally, or you can do it sector or thematics, which has become very popular. And at the moment, I think, again, going back to meme stocks, thematics is fabulous. I'm big on decarbonisation, the cloud, cybersecurity, but just be aware that when everybody decides that they want to get on that bandwagon, the prices are going to get pushed far too high. So I spend a lot of time in the second book trying to explain how ETFs work and how the weight of money can push share prices just far, far too high. And that's just important for people to appreciate.
Yep. Yeah, fantastic. Thanks for that explanation. And so you're looking, I mean, even just the US and Australia alone, you've probably got 10,000 choices of companies to look at. So how do you actually start to look for investments? Do you go top down like you were talking? Do you say, these are my themes and this is where I'm going to look? Or do you have specific screeners that you set for companies that you look that way as well?
Yeah, so in Australia, I read the AFR and I use an FN Arena subscription service because I find that really, really helpful.
Mm-hmm.
And I keep an eye on the macroeconomic, the Australian economy, as to whether, I'm deciding like if I want to hold some Commonwealth Bank or whether or not I want to, still position myself more in the likes of the REA and a car sales and stuff like that. In the US, I do a lot of listening and a lot of reading. So basically, I get a lot of CNBC,
Mm-hmm.
but also if research comes my way or I'm sometimes, for example, this is a really good example. So I was listening to CNBC and I subscribed to the Pro service, which I think is about 400 a year. And they were talking about the top performing stock on the S&P, and I'm like, oh, okay, what's that? Anyway, the second best performing was a company called MSCI, and of course we all know MSCI, and it does indexes, but it's basically become a data analytics company. And I thought, oh, interesting. If that one sells off, that could be quite inflation proof because at the end of the day, you're gearing into the growth in passive investing, ETF products, indexes, fund managers. They're doing a big push into how you analyze ESG metrics for fund managers. And they're becoming data as a service company as well. And funnily enough, I did buy it in the pull off of the sell down that we saw in September. And the funny thing was I just saw Credit Suisse had just named that as one of their picks as what would be perceived as an inflation-proof stock. Because at the end of the day, that whole money management industry across the globe is just, continuing to roll on. And they will have pricing power and data and software analytics or data analytics is going to continue to grow. So that's a classic case in point. Yeah. And it's really hard to tell people. A2 Milk, I was literally driving one morning and I heard on RN the guy talking about this, new company, A2 Milk. It probably wasn't even that new, but I got on board that very early. So I heard him. And then I went home and I had a look at the company and I'm like, oh, this is really interesting. So that's how I got into that one. But it's always really important to understand, like if I find a CEO interesting when they're talking, I then go through a series of processes. I look at the market cap of the company. I look at the liquidity in the shares. I look at the financial analytics of the shares. So are they loss making? Are they making money? Kind of what are their margins like? And things like how long have they been listed? And then am I comfortable with the industry they're in? Typically, I like to buy the best in class or the best companies in an industry every time, the higher quality companies. That's what I tend to gravitate to. I don't like buying cheap and cheerful for a bounce because I usually just make a huge mess of it.
Yeah. And when you're doing that research, so looking for those three things that you mentioned earlier, are you doing that from company websites? Are you doing that from CNBC? Where do you generally find that you?
Yeah, so basically, if you subscribe, you can. They summarize a lot of those analytics, and I described it in detail in the first book how I did it.
Yeah.
So it is literally one obtains a snapshot. I know guys love to analyze spreadsheets and balance sheets and P&Ls, and you love to recreate the whole thing. I have this view, there are so many analysts out there doing the work with the best will in the world. They're probably going to do a better job than most of us.
Absolutely.
The exception being Tesla, because Wall Street had no idea, did not understand the company. And Tesla has actually created this whole new breed of Tesla nerds that model the company, and they are the go-to people. That's who you want to listen to, with the exception of a couple of people like the guy from Morgan Stanley and the guy from Piper Sandler. But I really say that, you're just looking for relatives. Is it a highly geared company? Is it cash flow positive? Has it been increasing its dividend over time? I don't really think, unless it's a small cap, and that's a very niche market, and there are some great small cap analysts in here that have services, people like Claude Walker and Owen Raskovich does stuff there as well. So there are people out there that you can glean about the small caps, but the major companies, I don't reinvent the wheel. I think that's a waste of time. I heard a guy in America talking, and he said, why am I a good investor? Not because I'm any better at analyzing the company, it's because I understand how the herd think. And understanding how the herd thinks is a huge advantage, because if you understand that the herd is going from A to B and you disagree with that, then you can take the opposite position, if that makes sense.
Yep.
And that's really important to understand what the herd's doing, because markets, people behave in herds. It's just the way we are.
Yeah, absolutely. Yeah,
no one wanted Afterpay at $9, but everybody wanted it at 160 or 120.
Absolutely. A funny story about Afterpay. I actually, during the COVID crash, I went into to buy a whole bunch of stock at that point. I think it was about $12, and I pressed my buy order and realized I'd actually fulfilled it on my daughter's account. So I'd set up a trust for my daughter, and I've hit the buy order and it's gone, what have I done? Anyway, so my daughter's got a pretty good account these days, but yeah, my mistake.
That's perfect. Lucky daughter.
Yeah,
she's going to have some Square shares now.
Yeah, she's done very well as a 2-year-old in the stock market. On that note, I suppose one last one before we wrap up. As a parent yourself, how do you, I suppose, invest for your child or teach your child around the values of investing for the future? Now that, yours is all grown up now, how have you taken him on that journey to learn about money, and did you invest for him, or what was the process for you?
Yeah, I'm not sure he's all grown up at 20. He would argue otherwise. I basically gave him some money, and we put it into a Magellan fund that had just listed. Mm-hmm. And I said, okay, that's yours. And he was also starting to work and save money. And really, he kind of did it off his own bat. He made, 10 or 12% or whatever on Magellan. And he went from there, and then he goes, you're investing in the US. And I gave him, people are going to think I talk about Elon Musk a lot. Well, I do, sorry. But I'm very open about that. You just have to look at my social media feeds and my writings. But he read the Elon Musk book, and he kind of does his own research now, and he does his own stock picking, but he's at university and he's got at least 2 jobs and a massive social life, so he kind of looks after it himself now. And he's big into Bitcoin or cryptos as well. He's got quite a lot in that, and it's his journey to have now. He has to learn by when he loses and when he makes money, and if he should take profits. But he does berate mum for selling Linus at 17 cents. Say no more. I think it's $8 something.
Yeah, it's okay. That's hilarious. And so did you have to sort of guide him early days on what it was you were doing, or has he kind of just picked up an interest in it because that's what
he's doing finance as well, so okay. It does help.
That
helps. And also he's just we must have chatted about it, but I don't know, it's sort of him and his mates are kind of doing it together, and they've got an investing club at university. So fantastic. They all sit down and discuss it, and so they're all into it, which I think does make a huge difference. So occasionally I'll get in a question like, what do you think of plug power or whatever? And, I said, you've made so much on your Fubo TV, sell it. And he's like, no, I really like the company. I said, oh, okay. And then he goes, why is it going down, Mum? I said, oh, well, probably it was expensive and earnings went up to expectations. But it's important for him to just learn, and he has been saving a lot. And I think it's quite interesting because I'm doing a big webinar for women and investing tonight with eToro, and it's really interesting, the dynamics between men and women. Like guys kind of go, oh, we're all going to chat about it together, and we're going to get together and we're going to talk stocks, and girls, they like get the whole saving thing, but they really, really struggle with pushing the buy button. And it's a shame, because hopefully your daughter will realize that it's a wonderful way of creating some financial security and independence. And I think it's really important that everybody can get across it, not just all the male listeners out there. You know, it's up to, like my friends, women who invest, it was actually their fathers or their grandfathers that taught them, which is just, I think, quite an interesting observation. Whereas I had to just learn myself, because, you know, that's just the cards that I was dealt along the way. But it's been really important for me in my life journey to develop these skills, because sometimes life doesn't pan out the way we all expect it to. So I always say it's a bit of an insurance policy.
Yeah, that's fantastic. And hopefully my daughter doesn't think every stock just does what Afterpay does when she's old enough to understand what it is.
It'll be square by that stage. You may have sold it.
Yeah. All right. Well, that sort of takes us to the end of today's episode. Really appreciate you coming on the show, Danny. If people wanted to buy either of the Shareplicity books, or if they really liked what they heard from you today, where do they go to purchase the books?
Yeah, so you can buy them online. So they're on Booktopia, Amazon, all good bookstores, author signed copies available on my website, shareplicity.com.au. And there's also blog pieces, and I'm on social media, Twitter, Instagram. Instagram doesn't really do very much. Twitter's more active. And Facebook, I just repost articles. So there's quite a lot out there. You can reread old blog posts or listen to old interviews, podcasts, YouTubes. I have done a few YouTubes, which I think are very interesting, that have tried to focus on different topics. And so there's Shareplicity talks as well.
Yeah, fantastic. I'll pop some links in the show note to the books and to some of your social feeds. Thank you again for your time today. Really appreciate it. I've taken a lot away from it, and I'm sure our listeners will as well. So enjoy the rest of your day. Thank you very much.
Thanks, Dale. No problem.